Let's get into some business news here on Newsfeed. PM delving deeper into that budget story. Enoch Godongwana will have to have all the answers when he delivers the country's budget on Wednesday. Now, after two rejected proposed budgets and a 75 billion rand revenue shortfall, the finance minister and his team will have to table a pro-growth budget while avoiding major cuts. Now, joining me for this conversation is Tertia Jacobs, a Treasury economist at Investec. Tertia, it's important to note that both the domestic and global macroeconomic outlook have worsened since the withering of Budget 1.0 and 2.0. The world is in a different state now. We do have our president also meeting the US president tomorrow. So what kind of budget would be enough then for Enoch Godongwana to table come 2 o'clock tomorrow? Because he has to make sure he pins that particular shortfall, but also delivers in terms of growth.
Hi, hello, Matteo. Yes, I think your questions hit the nail on the head. And I was also listening to the commentary of all the interviewed people. And, the big takeaway is we need growth. We need money to be spent on South Africans, which actually means we need service delivery. The money must go where it's meant to be. And then what can we do to create jobs? And that's also a function of growth. Now, to your point, then, what's happening to the macroeconomic environment? Subsequent to the February and then the March budget, the global backdrop has actually deteriorated. So, Finance Minister Enoch Godongwana is actually going to table weaker macroeconomic growth forecasts. So, for example, in March, they were still hoping that the economy can grow by about 1.9%. Now we're looking at about 1.4, 1.5%, and that is actually their worst case scenario. So there are consequences of weaker growth economy, which is basically lower tax revenue growth.
Then looking at that 75 billion rand shortfall in revenue, what fiscal room does Finance Minister Enoch Godongwana have to work with in this particular budget? Does he borrow? Does he cut? What would be the main top things top of mind for him?
So I think the starting point is, in a way, we should work backwards, right? So usually we look at the expenditure and the revenue starting off with the growth in the economy. But this time around, we look at the budget deficit, and with South Africa's debt to GDP ratio sitting at about 76% of GDP, and, the government spending like 22 cents out of every rand on servicing debt, we cannot really afford to finance higher spending by an increase in borrowing. So it means that there has to be better balance between what happens to increases on the expenditure side versus what's happening on the tax revenue side. So that takes us back to Budget 1 and Budget 2, with more revisions coming in tomorrow.
Now, growth is low in South Africa at below 1%, while unemployment is surging past 32%. What levers are there for Enoch Godongwana to use in order to raise a budget that would grow the economy and also create those job opportunities?
So I think the first issue is that we need a more growth-orientated budget. In the past, every budget usually had has been accompanied with an increase in some kind of tax increase. And last year, National Treasury resorted to bracket creep, which is when you receive a salary increase and you move into a higher tax bracket, there's no alleviation. So this is likely to play out again. So I think the focus then on the expenditure side is that we should spend money more efficiently, and there should be more money spent on infrastructure. At the moment, the compensation budget remains quite elevated. So I think that is also where the government's got to be reconfigured. And there should also be an increase in the professionalization of the public sector, so that we can have a public sector that is more efficient and can actually deliver. That is the way we're going to accelerate growth.
There are a lot of vulnerable South Africans in the country who rely on grants and the big social wage bill that Treasury has in order to make sure that they were well taken care of. Obviously, that shouldn't be where he would cut. Would he even think of such a possibility?
No, I don't think so. They won't touch that. There may be in future investigations in terms of the various social grants, how to streamline some of the various grants that we have, but it's unlikely that there will be any major cuts.
Debt to GDP is already high, with the country's budget repayments taking a chunk of the budget. Would borrowing more be an option? Or S&P, also the ratings agency, saying that the South African budget is likely to go up in terms of debt to GDP to about 80%. So they're already pricing in that Treasury might need to borrow more for this particular budget.
I think that is not our base case scenario. That remains a risk going forward, especially if growth does not accelerate over the medium-term economic framework and government does not manage to rein in expenditure. In other words, you will need tax increases all the time to finance higher expenditure. So that is a major challenge going forward. But I do think in terms of Treasury's commitment to consolidate debt, we can get there. But again, growth is going to be the key focus point, not for this year alone, but in coming years.
Moody's, another ratings agency, looking at Transnet's bottom line, saying they could run out of cash in the next 3 months. Does this pressure Treasury then to have a few guarantees and bailouts for the likes of Eskom and Transnet?
That is truly a difficult question. We know that there's quite a lot of developments on the regulatory front. The Minister of Transport has sent RFIs to the private sector for how they would like the corridors to be fixed. But in terms of Transnet's own balance sheet, there are major challenges. So, and then, that should also be married by the trade unions that want substantial salary increases, which Treasury cannot afford, threatening to strike, which will be even more negative for growth. And then the very high debt level of Transnet, where the debt needs to be serviced. So how the government or National Treasury is going to deal with it, we're not entirely sure. Government has indicated that there will be guarantees for bonds that may mature during the course of the year. But I think the key issue is, what is the end state of Transnet going to look like? We're not there yet. So there's quite a few moving parts that's unfolding.
Is there a possibility then to tap into the South African Reserve Bank's gold reserves that we did last year, withdrawing 150 billion rand to try and balance the spending in the country? Is it a possibility to then walk to the SARB and say we need a little bit more?
Anything is possible. In the previous fiscal year, Treasury received 100 billion. And in this fiscal year and the following fiscal year, another 25 billion rand has been set aside. So in terms of whether there's more allocations possible, it will depend on the extent to which the gold and foreign exchange reserves have again been revalued. And yes, this time around, the gold price has provided an improvement. However, the gold price is quite volatile. So basically, the Reserve Bank may actually need a bigger buffer. So we're not sure if we're going to go there, but I guess it's an option that can be considered.
Treasury has promised investors to keep to reforms, which Enoch Godongwana has done well, especially when it comes to the tough love on SOEs or not giving out bailouts. But do you expect tomorrow's budget to still toe the line of South African reforms, especially as the market watches on?
Very important point. I think for us, the key focus point is that policy continuity will continue. So here is the GNEU remains intact. We know that there is growth reform, that there could be more momentum for the implementation of the infrastructure program. We have seen Operation Vulindlela's 2 new priorities being announced. As I said, there's hopefully more movement on the logistical side. So I think in terms of the tough love, we are watching for the Transnet story, but also the focus on the infrastructure spend.
Then for the South African consumer and the South African households that watch on for the third try at a budget, How do you expect them to be affected tomorrow? Of course, the VAT question is out the window. That's not going to happen. But how are they going to be affected by this particular budget, given that they're already strained in an economy that's growing low and also the cost of living quite high?
So I think the focus then tomorrow compared to budget 1 and 2 is that there will no longer be any VAT increases, right? So that is where the revenue forecast could be reduced by at least 13.5 billion rand, although the gap will be bigger because of slower GDP growth forecast. We do expect that the bracket creep will remain in place because Treasury has to close a few holes for some of the expenditure. So that will impact the middle and the higher income groups. And what also happens is that lower income people will also be lower income earners may also be drawn into the tax net. So I think, the takeaway here is that we need to widen the tax base. And I think perhaps I can just add the role of the South African Revenue Services will become more important. In Budget 2, the Minister of Finance announced an allocation of 8.5 billion to SARS. And I think that is where they will zoom in more in the efficiency of tax collection, start tackling some of the illicit areas closer to increase their revenue take, because over the medium and longer term, I think that's going to be a key area.
Right, that was Tertia Jacobs, Treasury economist at Investec.